Welcome to the Deep Dive, where we really cut through the noise of earnings calls.
Yeah, trying to find those nuggets of insight that actually matter.
Exactly. Today, we're diving into Universal Logistics Holdings, ULH. It's their Q2 2025 earnings call.
And there's a bit of a puzzle here, isn't there?
There really is. They missed their financial targets this quarter. GAAP EPS was $32. Consensus was looking for consider 34 cents.
Right. And revenue, too. $393.8 million versus estimates around $398.5 million.
Yeah, a miss of about 1.2% and down almost 15% from last year.
Oof, 15%. That's pretty significant year over year. Operating income also took a hit.
It did. $19.9 million. That's a 5.1% margin. Last year?
Yeah.
$47.1 million. Big difference.
And EBITDA followed that trend, down from about $85 million to $56 million.
So you hear all that, right? Misses year-over-year decline.
But then you look at the stock reaction after hours.
Exactly. The market reacted, well, pretty enthusiastically, a significant uplift.
Which tells you investors are looking past those headline numbers. They must be seeing something else.
That's what we want to unpack. What did they see? What's the strategic story here?
It suggests confidence in management, in the strategy, maybe in the forward guidance. They're looking ahead.
Okay, so let's dig into that. If the overall numbers were, let's say, underwhelming, where did the confidence come from? Let's look at the segments. Sounds like a mixed bag.
Definitely a mixed bag. Let's start with contract logistics. That's their cornerstone, as management puts it.
The stable part of the business.
Pretty much. Revenue there was $260.6 million. Now, that was down slightly, about 1.1% year over year.
Okay, but only slightly.
Right. And crucially, the operating margin held up well at 8.4%. Very solid.
And they had that Parsec integration, right? The acquisition.
Yeah, that went smoothly, apparently. Contributed $55 million in revenue this quarter.
So that helped bolster things.
It did. Especially, you remember they finished a big specialty project back in Q2 last year worth about $45 million.
So if you factor that out, the underlying business looks even more stable.
Exactly. And they're growing the footprint here. 87 value-added programs now, including 20 rail terminals. That's up from 68 programs a year ago.
Okay, so contract logistics is the anchor.
Yeah,
solid base.
Definitely. But then you look at intermodal.
Yeah, that's where things look tougher. Facing some serious headwinds, weren't they?
They were. Revenues down 13.5% to just under $69 million.
Ouch. And an operating loss.
Yep, $5.7 million loss. However, and this is, I think, part of that puzzle we mentioned, that loss was actually a big improvement from Q1.
Really? How much better?
Q1 loss was almost $11 million, $10.77 million. So they cut that loss almost in half sequentially.
Okay, that is a notable improvement. They're moving in the right direction, at least.
And the operating ratio improved, too, from 115.1 down to 108.2. Still over 100, meaning costs exceed revenue, but
getting better. A sign of tighter cost control, maybe.
That's the goal. Management wants this segment back to profitability by the end of the year.
What are they doing to get there?
Sounds like the usual playbook, but aggressively. Optimizing operations, getting out of unprofitable business.
Shedding bad contracts.
Seems like it. Plus, cost rationalization, centralizing customer service, and ops. It looks like those actions are starting to bite, starting to show results.
Okay, so intermodal. Still losing money, but the trajectory is improving. That's maybe something investors latched onto.
Could be. Then there's trucking.
Right. Now, this one was interesting. Big revenue drop, but margins went up. How does that work?
Yeah, it seems counterintuitive, doesn't it? Revenue fell almost 30%.
30%?
Yeah.
To $64 million.
Mostly because load volumes were down over 22%.
Okay.
But operating income actually improved slightly to $3.3 million, and the margin ticked up to 5.2% from 4.8% last year.
So less business, but more profitable business.
Exactly. It's all about their focus on specialized freight, specifically this wind energy business they keep mentioning.
The niche strategy.
Precisely. They're letting the older agent-based business shrink. That part is very tied to the soft industrial market. Lots of flatbed, metals, steel.
So they're deliberately shifting away from that more cyclical commodity stuff.
That's what it looks like. Focusing on where they have expertise and can maybe get better pricing, higher value niches.
Makes sense. Less volume, better quality revenue.
That seems to be the play.
And that focus on specialized freight, like wind, sounds like a core part of their growth plan going forward.
Absolutely. And to support that, they're really beefing up their sales engine,
How so?
bringing in new exec leadership for sales across the whole
Smart.
company, expanding the team with senior sales directors.
Getting more feet on the street, basically.
Yeah, and smarter selling, too. They're rolling out a new CRM system.
Customer relationship management.
Right. To get everyone on the same page, track activity better, and get a handle on what they said is a growing $1 billion sales pipeline.
$1 billion pipeline.
Okay.
That's definitely noteworthy.
It is. And it all feeds into this wider strategy of sort of repositioning the whole business.
Moving away from the basic cyclical stuff.
Yeah, shifting from that commodity logistics towards more differentiated services, things that can support better margins, building resilience.
So, diversifying services, tightening operations where needed, like in Intermodal.
And being selective about growth, trying to build a business that's less vulnerable to the ups and downs of the general freight market.
And that wind energy business just keeps popping up. They sounded really optimistic about that.
Extremely. They talked about a clear runway for the next 5 years through 2030.
Wow, 5 years. Why so confident?
Seems to be driven by government incentives. They mentioned a one big beautiful bill, legislation boosting clean energy projects.
Policy-driven demand.
Exactly. They expect 2027, 28, 29 to be, quote, pretty fruitful years as projects really ramp up.
So that's a potential long-term tailwind for that specialized trucking segment.
A very specific one, yeah. They think it'll more than make up for any slow start they had this year in that area.
Okay, so they're trying to carve out these stronger niches, but they can't completely escape the wider economy, right? The macro environment's still tough.
No, definitely not. The whole freight market is soft. People are talking about an industrial recession.
And that impacts ULH too.
For sure. Tariffs, for example. They specifically called out an impact on Intermodal in May and June. Volumes dropped from discount retailers who source a lot from China.
Interesting. Did it hit other segments?
Less so, apparently. Automotive production held up okay, just a minimal fall off. But yeah, it's a challenging backdrop.
What about the big trucks? The Class 8 market? Any insights there?
Still facing uncertainty. That soft trucking market plus all the regulatory questions.
Like the new ACT standards for 2027 engines being rolled back? California emissions rules.
Right. It's muted demand for new trucks. People aren't rushing to buy before new rules kick in like they might have before. Fewer new trucks means less capacity pressure, maybe, but also signals weak confidence.
Any bright spots mentioned on the macro front?
A few potential glimmers. Management thinks there might be some pent-up demand, maybe a modest pickup in Intermodal in Q3 as those discount retailers restock.
Okay.
And they sounded kind of optimistic about automotive production in some U.S. spots for the second half, so not all doom and gloom.
Right. So let's circle back to that initial puzzle. Missed earnings, challenging market, but the stock pops. Why? What's the investor take here?
I think it boils down to investors prioritizing the story and the execution over the immediate quarterly numbers.
The strategic initiatives, the cost control.
Exactly. The discipline they're showing, especially in intermodal turnaround efforts, the resilience in trucking margins through specialization, that seems to be resonating.
And the forward guidance probably helped.
Absolutely. Giving guidance of $390 to $410 million for Q3 revenue and $1.6 to $1.7 billion for the full year with consistent margin outlooks, that provides some reassurance. It signals management feels they have a handle on things.
A path forward, even if it's bumpy.
Right. And don't forget the dividend.
Ah, yes. They declared the regular quarterly dividend, 20 OGs, 5 per share.
Payable October 1st. That's another signal of confidence, right? Suggests they feel good about their underlying cash flow even now.
So the narrative is, yes, the market is tough, but ULH is actively transforming, moving away from basic commodities towards specialized higher margin areas like contract logistics and wind, fixing the weaker spots like intermodal. That's the story investors are buying.
It certainly looks that way. It's a story about active repositioning and operational discipline, aiming for long-term stability and better growth prospects. They're not just passively waiting for the cycle to turn.
Okay, that makes a lot of sense in context. Now, before we wrap, it's time for our This Is Not Financial Advice segment.
Definitely not financial advice, just some thought experiments. Illustrative purposes only.
Absolutely. Do your own research, make your own decisions. So what's an outrageous but plausible idea based on this call?
Okay, idea one, long ULH, specifically as a wind play.
Focusing on that long runway they mentioned?
Exactly. That clear runway through 2030, those pretty fruitful years coming from 27 to 29 thanks to the One Big Beautiful Bill.
So how would you structure that, hypothetically?
An outrageous but plausible approach. Maybe buy deep in the money call options that expire out in, say, early 2027.
Deep in the money calls,
Yeah.
meaning the strike price is well below the current stock price.
Right. It gives you less leverage than out of the money calls, but more certainty. You're basically betting that as those wind projects really take off, the market will increasingly price that long-term growth into ULH stock.
Leveraging the expectation that this specific niche offsets the broader, more volatile freight market.
That's the thesis. Again, purely hypothetical, not advice.
Got it. And a second idea, maybe something relative.
Yeah, idea two. A relative value play within logistics.
How would that work?
Recognizing ULH's strategic shift towards these specialized, potentially higher margin niches.
While other players might be more stuck in the general freight slump.
Exactly. So you might consider going long ULH shares, but pairing it with a short position in, say, a broad trucking or intermodal logistics ETF, one that's more exposed to the general commodity side of the business.
So you're betting ULH outperforms the wider, more generic sector because of its specific focus and cost discipline.
That's the idea, betting on their strategy to deliver relatively better results in this environment. But again, just an illustrative concept.
Understood. So recapping the whole deep dive, Universal Logistics Holdings. Q2 had some financial misses, yes, but the market looked past that.
Yeah, focusing instead on management's clear strategy, cost discipline, fixing underperforming segments like intermodal, and pivoting hard towards specialized higher margin businesses.
Especially contract logistics as the anchor, and that booming wind energy sector providing a long-term tailwind.
It seems like a story of active transformation in a tough market, and that's what caught investors' attention.
Which leads to maybe a final thought for you, the listener.
We saw how government action, that one big beautiful bill, can potentially reshape a whole segment like wind logistics for years. So the question is, what other government actions or big bills out there might redefine other parts of the supply chain?
And maybe more importantly, how fast can companies adapt to actually capitalize on those shifts when they happen?
Something to think about.
Definitely food for thought. Thank you for joining us for this deep dive into Universal Logistics Holdings. We'd love to hear what you think.
Find us at thedeepdive.com. Let us know your questions or insights.
Thanks for listening.